Good afternoon. I'm Rick Edelman. Thanks for joining us today for this very timely webinar, given everything that's happening in the world of crypto. From cash to code, investing in stablecoins and tokenization. Those are two of the hottest topics in the world of crypto, and we're going to tell you all about them. And joining me is Zach Pandl. He is the head of research at Grayscale, the oldest and largest crypto asset manager. And we're going to tackle all of this with you today on the call. Zach, join me whenever you're ready. There he is. Good to be with you, Zach.
Great to see you, Rick. Excited to get into the conversation.
Zach is like many has made the transition from the world of TradFi, traditional finance, over to the world of crypto, with a long history at firms like Goldman and Nomura and Lehman Brothers. Zach, take 30 seconds and explain why you made that jump from TradFi to crypto.
I'm happy to do that. Look, I was a macroeconomist studying financial markets essentially and thinking about how the behavior of the economy would affect things like stocks, bonds, other commodities, what you might call like macro assets. And at some point in that journey, I became convinced that of all those things, all the different types of currencies and commodities, that Bitcoin and the crypto asset class as a whole was the most compelling use of my time and my own capital. I just deeply believe in the investment thesis of the asset class. And I think as an analyst, there is nothing in financial markets as interesting and exciting as crypto. So I just wanted to spend all the rest of my working days on this topic. Grateful to be able to do that from the Grayscale platform.
Yeah, I've often argued that this is perhaps the most intellectually interesting topic in the field of finance. So I share your view. Grayscale, of course, a household name in the world of crypto, but share with folks some of the amazing stats about the company.
Yeah, we are a leading crypto asset manager starting back in 2013 when the price of Bitcoin was $125. Now we have more than 100 employees, 120, 130 employees, something along those lines, offering a range of products, ETFs, providing low-cost access to Bitcoin, Ether, leading crypto assets, as well as a private funds business serving accredited investors and everything in between. So really covering the whole waterfront of the crypto asset class and engaging with clients every day on these topics.
And you mentioned the long history of the firm. That's rare, quite frankly, to have such a history here. If you want to go through some of the highlights.
Yeah, absolutely. I would say a long series of firsts for Grayscale, starting with the first Bitcoin investment product in September 2013, again, ages ago in crypto history, and then a long series of steps in other products related to Ethereum, Solana, other leading crypto assets. Many people know Grayscale from the ETF story. It was a long journey to get Bitcoin ETFs to market, and it took Grayscale suing the SEC, suing our regulator, winning that lawsuit, which ultimately brought Bitcoin ETFs to market. And I would say we are continuing those series of firsts. One of the ones I would highlight recently is Grayscale today, the only U.S. asset manager staking in our Ethereum ETFs at scale, maybe something that we'll talk about on this call. So, driving the industry, the asset class, investing in crypto forward for a long period of time. We hope that continues well into the future.
Yeah, I'm glad you mentioned the lawsuit. It's an important reminder to everybody that if it were not for your lawsuit against Gary Gensler and the SEC, we would not have the Bitcoin ETFs, which means we wouldn't have any of the other ETFs that have followed and the incredible inflows that we have seen in the past 2 years. So kudos to Grayscale for making all that happen. As you can imagine, there's an awful lot to talk about here. In fact, many of the folks who are watching this have sent in questions in advance. I'll hit you with those. I invite you, if you're watching, to raise your questions right now through the Q&A box here on Zoom. I'll be taking a look at that as we go and hitting Zach with those as well. But although we're going to be talking a lot here today, Zach, about stablecoins and tokenization, we really have to start with what's going on in the world of Bitcoin pricing and Ethereum prices and so on today. We're in the middle of a crypto winter that I think it's safe to say nobody saw coming. So give us your overview. What has triggered in your mind this winter? What do you see happening next? Is crypto dead?
Well, No, crypto is not dead, but I think you're exactly right, Rick. We should talk about this right off the bat. Look, in terms of the basic facts, it has been a big drawdown, about 50% peak to trough so far in the price of Bitcoin. Even for a volatile asset class like crypto, this is a meaningful drawdown. By my count, it's the ninth largest Bitcoin drawdown in history. So 50%, that of course is a meaningful number. What I think is most important to emphasize is this has not been unique to crypto. Many frontier technology market segments, software companies, defense tech, ironically, quantum computing stocks, showing a similar pullback recently. So it's not been crypto per se, it's been a retreat from early stage tech market segments, essentially, of which many investors view public blockchain technology and Bitcoin as part of that story. And there's been different catalysts. I think if we had to talk about one recent catalyst, for this latest leg down in February, I think President Trump naming Kevin Warsh as the next Fed chair was a short-term catalyst. I was a economist working on Wall Street, as we've talked about, while Kevin Warsh was a Fed governor, and he was thought to be a hawk at that time. I don't know that he'll govern that way as Fed chair, but the knee-jerk reaction in markets is to price in a bit more caution with him, going through the nomination process. So there's been a lot going on, as always, and we'll get into a lot of that today. But I think it's a meaningful drawdown, corresponding to a pullback in lots of frontier tech assets. Just like innovation in those other market segments, in software and defense tech and quantum computers, innovation in crypto doesn't stop. That's continuing to power forward. Risk managing these things in markets is a challenge, just like in other market segments. I don't think crypto is dead. I don't think the winter, personally, will last very long.
You mentioned Warsh as a one of the reasons for crypto's decline lately. I agree with you. That is a factor. What I have found fascinating is that there hasn't been a singular event. We can point in the past to Mt. Gox or FTX or Terra Luna as a singular reason for a major round of pessimism. There hasn't been one this time, which is why I think the market's decline has caught everybody by surprise, certainly me. So I've got a white paper coming out, and I cite 9 of those straws that are breaking the camel's back. Warsh is one of them. We're going to release that white paper tomorrow. By watching this event today, you're automatically going to receive it. So watch for that in your inbox tomorrow, talking about not only why has Bitcoin fallen, but what's going to come next and what might be the other side of that coin. So watch for that new white paper coming out tomorrow. One of the things that I've found fascinating, we're going to be spending most of our time today talking about stablecoins and tokenization. Let's begin with the stablecoin conversation, Zach, because it has a leading question to what we've been discussing as to today's price declines. Before we get to that, explain fundamentally for folks watching who may not be as well versed in this. What are they? How are they being used in cash management? What's the purpose, or bluntly, what's the point of stablecoins compared to money market accounts, et cetera? Give us a 101 on this.
Yeah, let's start with the real basics. So, Rick, if I want to give you a cash dollar, I have my dollar bill, I hand it to you, the transaction is done. It's a peer-to-peer transaction in a bearer instrument, if you will. There's no intermediaries, nobody else involved, just you and me. I hand you the dollar. That's it. If I want to give you a digital dollar, though, what I actually have to do is I call up my bank and I tell them to start debiting my account, and they call up your bank and start crediting your account. And then over a settlement cycle of a couple of days, that doesn't happen on nights and weekends and public holidays, eventually it shows up as a credit in your account and a debit in my account. So our digital money system works through intermediaries and credits and debits, much different than the cash or physical system. Essentially, the breakthrough of stablecoins, which is just about blockchain technology underneath, and we can talk about all this, is allowing for that same peer-to-peer transfer of digital dollars, like we can have a peer-to-peer transfer of physical dollars. So if on the blockchain, you have an address, I have an address, or a wallet or an account, I want to send you $1, I press send, goes straight to Rick. from me, no intermediaries, no waiting, no other fuss in between. So it's a peer-to-peer transfer of a bearer asset, just like cash, but this time digital. And I find this just an absolutely fascinating and amazing breakthrough, and it's something that is already having important adoption on the ground. But this kernel of an idea is essentially what all of the technology in blockchain technology is all about. And we're going to do this for many other things, and we can get to some of this. We can transfer assets and other things in the same way. But a stable coin is just a type of digital dollar that I can send directly to you with no intermediaries. And that, in my view, is a big efficiency gain, a big breakthrough in how the financial system works. That's how I would explain to it at the most basic level.
And that is a really good, clear explanation. They've become popular already. Talk about the size of the stablecoin market.
Yeah, so there's different ways to measure this. In terms of outstanding size, is $300 billion in that sort of zone. The more remarkable statistic is probably the transaction volume. Now, a lot of this is in the context of crypto trading. I want to say to be clear. So stablecoins have taken off in crypto trading, but you're taking off now increasingly in payments. But in total transaction volume and settlement volume today, you're running at an annualized rate of about $10 trillion. That's about how much annualized is settling with stablecoins. And to put that number into context, the Visa network does about 13 trillion, and PayPal does about 2 trillion. So $10 trillion. This is big. This is a big business now. Again, a lot of that is crypto trading, but increasingly payments use case. So this is really one of the killer apps of public blockchain technology, something that has clearly found product market fit, is used all over the world, and is an important structural trend. And this is why regulators, legislators, they're very focused on this topic, because it's the thing that has most clearly taken off in the real world from crypto or public blockchain technology.
Stablecoins get their name, of course, from the fact they are stable, meaning the price isn't volatile like Bitcoin. And the big question investors have asked is, what makes it stable? Why is it that the dollar you put into a stablecoin is always a dollar? Explain that background.
Yeah, it's a real simple idea, and this is a financial professionals audience on this call. I think just think about it in assets and liabilities. The stable coins are a liability, and the assets are safe, secure assets. So the structure of these things looks extremely similar to a government-only money market fund. Think about how those products work. You have things like treasury bills and closely equivalent assets like repo agreements and that sort of thing held by a government-only money market fund. And then it issues these shares that you hold, and those hold their dollar value. Different types of money market funds, riskier money market funds, have had ups and downs over the years. You mentioned I started my career at Lehman Brothers. The reserve primary fund broke the buck back in 2008. This was an important story in the financial crisis, but that was a kind of risky money market fund, not holding government-only assets. Regulated payment stablecoins, the type that people will see in the mainstream U.S. financial system, they are just like a government-only money market fund. They hold a reserve of safe assets that always backs those liabilities, and I can always turn in my stablecoins to get cash back. As simple as that, just like a money market, government-only money market fund, that's how it maintains that dollar peg.
And even to the point, the Treasury has recently said that stablecoins now hold, 10% of all U.S. currency?
Yes, they're becoming a major buyer of Treasury bills. And so it's short dated, short maturity bills. And so becoming an important source of funding our deficits. So Scott Bessent, the Treasury Secretary, has a big challenge. We're running big deficits all the time, and that means issuing bonds, issuing bills to finance the U.S. government. Fortunately, stablecoins have emerged as a marginal buyer of those assets. So, there's lots of things that we could talk about deficits over time. But at the moment, it's been helping the U.S. government finance big deficits. And if stablecoins continue to grow as a desired way to hold dollar balances, they will also become something that absorbs that supply of treasury bills and bonds from the U.S. government.
Which is why the Treasury Department loves stable coins because,
Exactly.
it might not be a big deal here in the US. I mean, I got a money market fund and it works fine. But if you live in a country with an unstable economy or a corrupt government, you don't want your money in local currency because of the inflation risk. Think of Venezuela, Zimbabwe, Argentina. The ability to put your local money into a stable coin that is backed by US dollars and treasuries is a wonderful way for you to protect your money in a way that Americans take for granted. And this is why it's going to be considered, already is really, as a way to help support the US dollar in the global economy, right?
Absolutely. We'll talk about the medium of exchange or payments use case of these things, but what you're getting at really is that store of value use case. Look, I would like to see the dollar be an even better store of value, maybe by kind of different fiscal management. I'd like to see our debt and deficits get under control. But as you say, outside of the United States, the dollar is still many leagues greater than other, especially emerging market economies that have even bigger problems with debt and deficits and inflation risk over time. And so in those places, the dollar has long been a natural store of value. There's a common term in macroeconomics called dollarization. When people start to accumulate dollars in emerging markets instead of their home currency. And that's taken lots of forms, cash bills, bank deposits, but now stable coins. Stable coins are a very easy way for people to hold dollar balances in these places as a store of value, partly as a store of value. And that protects them from the inflation and depreciation risks of their home currencies. Argentina, Venezuela, Nigeria, Turkey, all of these places are places where stablecoin adoption is fairly high for exactly that reason.
And now you know why the very first crypto legislation Congress ever passed last year was the Genius Act, which was all about stablecoins. Talk about what that bill predominantly did.
Yeah, so the Genius Act passed last July on a bipartisan basis, signed by the president. This gave a comprehensive regulatory framework for stablecoins in the U.S. Market. And there are a couple of different elements in there, but kind of two main things. The first is that it mandated by law certain rules about the reserve requirements. So I talked about how stablecoins maintain their dollar peg by holding safe reserves, treasury bills, repurchase agreements, things similar to that. This just mandated all the leading stablecoins are already operating this way, but it mandated in law all the specifics for that. So that's great, making sure that investors and the financial system are protected with those rules. So that's one piece, is reserve requirements. And the other equally important piece, frankly, is application of all the KYC, AML, and compliance type of rules that are expected of every intermediary in the U.S. financial system and are expected of stablecoin related intermediaries. The financial system has all kinds of rules to protect all of us from bad actors. And if stablecoins are going to be deeply integrated into the U.S. financial system, they need to have all of those same rules. Now, it's a misperception that there was no rules before the Genius Act, but it is important to see a major piece of bipartisan legislation signed by the president really putting all these things very clearly into U.S. Law. So there's other elements, but those are the two big ones. And I think about it as preparing the U.S. financial system for a world where stablecoins are many times bigger than where they are today. And if in that kind of world, we absolutely have to have safety for consumers and for the financial system as a whole. And that's really what, in my view, the Genius Act was all about, facilitating growth and adoption in a safe way over time.
And just to illustrate the size of this, you already talked about 300 billion and 10 trillion of trading volume, et cetera. I think most folks are not terribly familiar with Tether. We saw USDC go public last year, Circle, in a hugely successful IPO, one of the biggest ever. Tether has not been a US company. They're moving to the US in order to access our markets. But talk about the scale of Tether and how big this company is, because I think it's an under the radar situation.
Yeah. So where do these stable coins come from, right? So they're stable coin issuers. We talked about how our digital money works today, which is about using bank balances for me to transact with Rick. In the stablecoin world, the bank is replaced by these stablecoin issuers, and the largest U.S.-based issuer a public company called Circle, issues USDC. But the largest in the world is a private company called Tether, which is use a token, primarily token today called USDT, or the Tether stablecoin. This is sort of an offshore stablecoin. Tether may be one of the biggest private companies in the world by valuation. They press reports indicate that they were attempting to raise at a valuation of $500 billion a few months ago. That number may be a little bit high. I think certainly in current market conditions, I think it may become a little bit south of that. So maybe not quite as valuable as some of the largest AI companies, for example, but this is sort of the scale that we are talking about. One of the most valuable private companies in the whole world is a stablecoin.
Yeah. Last year they earned $10 billion. They have a higher EBITDA than BlackRock.
Right. Well, it's a pretty good business. You have all these treasuries earning interest, and you have your stable coins on the other side of the balance sheet that, at the moment anyway, don't pay interest. And so they're accumulating net interest margin just like a bank, and they have achieved a scale that it's become a very good business for Tether.
So we put all this in that framework to help give you the understanding that this isn't something you can ignore. It's going to become incredibly ubiquitous in the not too distant future. There's one element of stable coins you've already alluded to, Zach, the fact that they trade 24/7. You don't have to deal with banking hours, which are so severely limited, which is a huge advantage. What other advantages are there to stable coins over the way we traditionally handle money?
Yeah, think about the places where payments are most inconvenient today. This is potentially where the innovation could be most valuable. And simple things like cross-border payments at a retail or a business level, to me, are the most striking example. We're taking intermediaries out of the process. I just send my stablecoin directly to Rick. There's no bank or other intermediary in between. Cross-border payments often have lots of intermediaries, domestic banks and correspondent banks that sit between banks in different countries. And so they can be especially costly, slow, lacking transparency, these sorts of issues. And so stablecoins can potentially be a big breakthrough there. And this is anybody that's made a cross-border payment is familiar with this. You don't need to be a big business, although they are helpful there as well. Just sending a friend from New York to London money, you need to think about how are you going to do that? Is this going to be a bank wire? Do I have to onboard to some app that I can use its balance sheet to transfer? Am I just going to mail a check? There's different kind of options. With a stable coin, if you both have an account, I just send it directly to my friend in London with no intermediary. It's a very simple way to kind of cut out cost, cut out delays or reduce delays in cross-border payments. And you've seen adoption really in the places, emerging market cross-border payments have been one of the places where there's been a lot of adoption. These can be especially slow, especially costly, and sometimes there's problems in the financial system, risks that you're introducing when you are using banks to make these types of payments. So this is where a lot of the efficiencies gains have coming from. First, I personally think stablecoins will make much deeper inroads than just cross-border payments, but that's been the kind of the first beachhead, I guess, that stablecoins have attacked, and I think a lot more room to grow there, and then eventually domestic payments and other things.
Yeah, certainly the low-hanging fruit. I mean, it's not only faster and cheaper, it doesn't require banks, which a lot of folks, a billion people around the world don't have a bank account. Now they don't need one. All they need is a phone to be able to do this. You mentioned fees. Elaborate on that. I mean, we know that sending money cross-border can have fees of 6 or 7%, which is a massive number. What are the fees when sending money using a stablecoin?
Yeah, often very low. So it depends on, exactly the blockchain and the nature of the transaction and all this kind of thing. But it'll be in the matter of a small number of cents and potentially very close to zero. We'll see how this evolves. But some blockchains are introducing zero fee stablecoin transactions. So I think this number is going to get extremely low. Cross-border payments, I think people sometimes know that these fees are fat, but maybe I'll just remind people of the cost in a domestic payment as well. Just using big round numbers, if I swipe my credit card at a restaurant here in Connecticut, I spend $100. The restaurant gets approximately $97. $1.50 comes back to me in terms of card rewards. And then $1.50 is consumed by the network of banks and credit card companies that process that transaction. So what we're trying to, this is just one example of credit cards. The same goes for cross-border payments and lots of other things. What we're trying to do is reduce those fees. There's no reason that the network effect needs to be so strong that we're paying such a significant amount, in my view, to the network. This is a different way to set up digital payments, a different type of network, and hopefully will reduce fees for consumers and merchants and just make the financial system a little more efficient. And it's as simple as that. And I think that's a very important concept and a very important source of innovation in U.S. finance.
Two other things before we start talking about tokenization, which is the other big thing in crypto these days. The first is the notion of smart contracts. This has been one of the big bragging points for Ethereum in particular compared to Bitcoin, the notion of smart money. Talk about smart contracts and how they particularly relate to stablecoins.
Yeah. Great question. So when we think about the payment system that we have today, there's kind of two types of revenue. We've already touched on both of them. Banks earn net interest margin. And again, banks and credit card companies earn transaction processing fees. These are where the kind of the margin is in our digital money system today, if you will. In stablecoin, where we're going after both of those things. We talked about stablecoin issuers, Circle and Tether. They're going after the bank's net interest margin. What about that transaction fee? Well, we are replacing the existing network with a blockchain like Ethereum or a blockchain like Solana. So instead of a business like a credit card company earning those fees, they derive value to the underlying blockchain like Ethereum or Solana. So investors, of course, you can't invest in a stablecoin exactly. It's a dollar, right? It's a use case of blockchain. So it's just digital cash, digital dollars. If you want to invest in this thesis, if you want to invest in this growth over time, you want to think of those types of revenues. The businesses that earn the net interest margin, public company like Circle, but also the underlying blockchains like Ethereum and Solana. Now, these are the ways to kind of build stablecoin exposure into portfolio and how to get access, because they are earning the transaction fee that accrues value to the network itself. So this is why Ethereum or smart contract platforms like Ethereum are so important. They are the network that will process these digital transactions in the future, and owning those can be thought of as a way to position for growth in stablecoins and other use cases in a portfolio.
Well, so let me ask you therefore. You said that this stablecoin market is about $300 billion. It's mostly Circle and Tether, right? Mm-hmm. What percentage of market share do those two have, would you say?
I would say 80 to 90 at the top of my
head. So
big,
it's big.
Yeah.
And they execute their trades using the Ethereum or Solana blockchains, yes?
Exactly. I like the phrasing that you use there. Execute their trades in that way. Exactly.
Then explain why, and there's profitable, right? There's making a ton of money doing this. Then why are Ethereum's and Solana's prices crashing?
Well, good question. So, look, I mean, I think this is not so much about fundamentals, but about risk taking in markets. And all of your viewers are very familiar with this sort of thing in every asset class. The fundamentals tend to kind of move in a more gradual fashion, and markets overshoot and undershoot regularly, and that's the same in crypto as everything else. I think that stable coins, tokenized assets, regulatory clarity for blockchains, the things that we're talking about in this call, this is a mega trend, and as far as I can tell, nothing has slowed down whatsoever. But financial markets are driven by fund flows and sentiment and all these types of things, and so. Crypto is no different than any other asset class. And so you as a portfolio manager, as a risk taker, risk manager, this is what your job is all about. Of course, knowing when we've overcooked and maybe valuations are high relative to that trend, and knowing when there's value, when we've undershot. I believe we're at a value moment, that this mega trend continues, and that the assets are giving investors a pretty reasonable point to start incorporating these ideas into portfolio. That's my own personal view, but I think positioning in something like Ethereum, Solana, good ways to position for growth in this use case if you believe in this fundamental adoption trend.
Got it. Second last question regarding stable coins before we move on to tokenization, and that is the fact, and you mentioned it, but I want to highlight this. Uh, the stable coins don't pay yield, which is why Tether and Circle make so much money. They keep the yield they earn on the treasuries they buy with your money, and that makes huge profits for them. This is a legislative item. This is not an accident. This is the way the rules work. They're not allowed to pay yield.
Right.
Therefore, they're looking for alternative ways to generate yield for the buyers of stable coins. Staking rewards. Talk about how they relate to this whole conversation and the issue of yield generation.
Yeah, absolutely. I use the phrase net interest margin because people are familiar with that term for banks, but really it's gross interest margin because they don't pay any interest, so that part is zero. So it's just really all the gross interest goes right to them. Staking rewards are another way to generate a income like reward with public blockchains. So Ethereum, the network where the stable coins live, generates a native reward or income for users. So if I own Ethereum, I can just own the spot price of the asset, but I can also stake it and generate a type of reward rate or income stream on top of that of about 3% if I'm doing it natively today, for example. The metaphor we like to use is like agricultural land. You could own agricultural land without farming it, and you have a commodity, and maybe that goes up in price. But I can farm it and get a kind of native reward back out of it and get more denominated in that piece of land. This is kind of like the idea. I can own Ethereum and its price can go up and down. And I can maybe experience capital gains or losses from the movement in the price, but I can also generate a native yield by staking it, providing a service to the blockchain and earning rewards for that. Today, Grayscale, the only U.S. asset manager, as mentioned at the outset, staking in our Ethereum ETFs at scale. So people that are interested in that additional reward rate is something to think about.
Okay, let's move to tokenizing. Tokenization is all the rage. This is where there's massive hype, massive attention in the crypto world. The traditional finance world is all over this. Franklin Templeton, BlackRock, and others are already doing a lot of work in the tokenization arena. Talk about why. What is tokenization? Why is there so much hype about it?
Well, let's go back to the basics. We talked about earlier with the stable coin, I can send my digital dollar directly to you, Rick, with no intermediary in between. Essentially, stable coins are just tokenizing cash, taking cash and putting it on a blockchain to allow us to do that type of transaction. When we say tokenization of assets, typically what we mean is giving us those same benefits for asset markets, not just cash. So if I want to send you a stock or we want to trade on a peer-to-peer basis without any borders, without any brokers in between, I can do that with a stable coin. So tokenization just means taking assets, putting them on blockchain infrastructure, and getting the benefits of blockchain infrastructure. And these are things like a borderless transaction, near instant settlement, 24/7 trading, these types of benefits. And I think, of course, we're just getting started. And I think the reason that the buzz is so high, one is just that these are clear innovations in the financial system. But I think the buzz is high also because the scale could just be absolutely enormous of this trend. There are only about, in round numbers, around $30 billion of tokenized assets on blockchains today. And when you say billion, it sounds like a big number. But that is only 0.01% of outstanding stocks and bonds in the 1 basis point. So tokenized assets are something that is again a mega trend in financial services. And we're at the very, very beginning stages of this process. So, I think investors should be preparing for this clearly. This is, yes, it's buzzy now, but over the next 2 and 5 and 10 and 20 years, this is just going to become a bigger and bigger story. So now is the time to get educated when we're at the very kind of beginning of this process. And it's something that's going to be carrying on for a long time. I think that's one of the reasons that it's so in focus at the moment, is that everybody's getting educated on something that's going to be a trend in our industry for a long time.
Because the whole point is that when we take an asset, a stock or a bond, and tokenize it, putting it on a blockchain, we are now dealing with 24/7 transactions, dramatically reduced fees, increased cybersecurity safety, and the fact that we can now do this without an intermediary, as you've described, and it's faster, safer, cheaper than the current methodology that we're dealing with. Instead of a T+1 settlement, it's instant. It's T+0. So it allows business to operate at the speed of the internet. And that, although it's 1 basis point of the total stock and bond marketplace on a global scale, you've only referenced stocks and bonds. You haven't referenced real estate, which is 4 times bigger than the global stock market. We can tokenize anything, right? We can tokenize baseball cards, and we can tokenize exotic wine and rare cars. We can tokenize any asset.
Yeah, absolutely. Very well said. I use that stat. It's a nice round number, but you're right. The scope is much beyond just stocks and bonds. All of these types of things, alternative assets, physical commodities, really anything. This is the direction of travel for the structure of the financial system as a whole. And one thing I'd like to emphasize, Rick, to your point on what is the point of all this, right? It's just moving us forward, moving the financial system forward in terms of efficiency gains, reduction in costs, and hopefully, and I think, with the right choices on market structure, reduction in risk also. So the consumer experience is going to be similar. You're going to have a web interface, your brokerage account or whatever, and you're going to press buy and sell. But the behind the scenes, kind of the back end process will change, and it'll give you more functionality. It'll give you lower costs, faster settlement, 24/7 trading, global access, access to assets all over the world, and ideally lower counterparty risk and that sort of thing as well. So it's just a back-end innovation for the financial system, which is, if you're interested in how the financial system works, a very exciting idea. But I think for most consumers, it'll just be little gains in their life, just a little bit easier to manage their finances.
Yeah, this will all just be back office kind of stuff.
Back office stuff. Yeah.
They're not going to care about how or who or where. It's just going to be the benefits that they're enjoying. End of story.
Correct.
But here's the $1 million question for you, and it might be the $1 trillion question for you, Zach. What is all this stable coins and tokenization? What does all this mean for Bitcoin, for stocks, for the asset management industry and financial advisors? So what are the implications on all this? Who is going to get disrupted? If stablecoins grow, isn't that at the expense of the banks, for example? So explain who gets disrupted out of all this.
Yeah, great question. Let me start by where the most direct beneficiaries are. And that, again, goes back to the underlying networks that are going to hold and process these transactions. So smart contract platforms, this is a mouthful of a term, but everybody ought to get used to it because you're going to be hearing it over and over the years. Smart contract platforms, these networks that process these transactions, like Ethereum and Solana. Those are the two leading ones. These are the most direct beneficiaries from these changes. So we're changing the market structure of our capital markets, moving away from a system dominated by transactions between intermediaries, brokers, custodians, etc., and moving more of this process onto open source technologies, smart contract blockchains like Ethereum and Solana. So those are the most kind of direct beneficiaries. Who is going to be disrupted in this process? Look, anything that can made much more efficient with a programmatic contract is likely to be disrupted. And so, banks that earn a fair amount of margin on cross-border business, cross-border kind of treasury business, that's an obvious place that will likely be disrupted by stablecoins. Correspondent banks, other things that are kind of a part of the legacy system. When we talk about capital markets, I do think it's fair to say that there's still a fair amount of uncertainty on exactly what the market structure is going to look like. But traditional players that are in the business of moving paperwork around in some shape or form, eventually they will be disrupted. Now, I want to say eventually, because the financial system is not just about technology, it's about all kinds of laws and rules. And we may live in a hybrid system for a little while where the tokenization engine gets going, more transactions are taking place on blockchains, but we are duplicating some of that in traditional kind of paperwork, if you will, in order to comply with laws. So I think that many of those institutions that are kind of processing transactions, they will be disrupted, but they may hang around for longer than you expect to make all of this compliant with securities laws. And eventually, as the legal frameworks catch up with our tokenized future, those institutions will eventually go away. So, but to answer your question most directly, focus on the beneficiaries, the smart contract platforms that are processing and holding these assets, and the companies that are providing services around that. Those are going to be the winners in our tokenized future.
So we've got a bunch of questions from folks. Let me hit you with some of these because they're all on point to everything that we're talking about. VJ has asked, explain the relationship between Bitcoin and stablecoins. Do stablecoins render Bitcoin obsolete?
No. Think about it maybe as does Venmo make gold obsolete? Maybe is the metaphor that I would like. One is a payments technology. Stablecoins are payments technology, and they'll compete with things like Venmo, and they will make our payments system hopefully faster, cheaper, safer. That's the goal of stablecoins. But Venmo doesn't make gold obsolete, because the reason is the Venmo is still based on dollars, and we are taking risks with the dollar and those are macroeconomic in nature. We're running big, enormous deficits, and the debt stock keeps going up, and this creates the risk of inflation over time and demand for scarce assets like gold. Bitcoin is to crypto as gold is to the traditional financial system. It's a asset, a commodity that is autonomous from governments and is a scarce object. It's a digital object, so we don't usually call it that, but it's a scarce commodity. And so it can't be inflated away in the same way as fiat currencies. So I would think of Bitcoin as competing with gold, stablecoins competing, if you will, with things like Venmo, not to pick on Venmo, but kind of payments technology, the way that we process payments. That's how to think about the difference.
And in fact, that is a couple of questions we're getting from some folks on that point. Why? We've got Venmo, PayPal, and Zelle. Most folks don't know Venmo and PayPal are owned by the same company. But we've got those three payment systems in place today. Aren't they good enough? Why are stablecoins superior? I mentioned cybersecurity and safety. Explain why I did, and compare those three to stablecoins.
Yeah, there's a couple of things, but number one is international, cross-border. These apps do not work in an international sense unless this certain company. There are of course some in Western Europe that cover lots of different countries, but you have to be on one of these apps that has a cross-border presence for it to work. Stablecoins, blockchains are native to the internet. There is no concept of a border. And so if someone's in London, if someone's in mainland China, I can send a payment in exactly the same way. So international access is a key beneficiary. And the other thing to your point, Rick, is the safety and counterparty risk thing. If I'm transacting balances on a financial institution's balance sheet, I still have risk to that institution. A stablecoin is kind of like a bearer instrument backed by treasury bonds. And so I'm not taking credit risk. There is no mortgages or other types of loans that are being made by a stablecoin issuer. It is a narrow bank, if you will, to use that type of textbook terminology. And so potentially you are reducing risk in some way. So there's maybe some other aspects you could add, but I would highlight those two: international access and the nature of counterparty risk. Those are key differences between these kind of closed system apps.
And many would argue that the decentralized nature of blockchain renders them more cyber safe. The Bitcoin blockchain has never been hacked. Pretty much the joke is in cybersecurity circles is that there are two kinds of companies: those that have been hacked and those that don't know they've been hacked.
That's a good way to put it. Look, I would think maybe use the term also front end and back end innovations. Stablecoins, blockchains, these are kind of back end innovations for the financial system. We have had front end innovations over the last 10, 15 years, fintech apps that have given us new types of experiences. And you've talked about some of those here, but they still run on the legacy infrastructure. We want both things. We want to be able to have a kind of new fintech type experience, a mobile app on our phone for making payments, but we need to upgrade the back end to get really the longer mile benefits. And that's what blockchains and stablecoins are giving us. So maybe that's another way to think about the difference between these apps that you mentioned and stablecoins.
Rover is asking a question, and he may be picking up on something he's heard me say in the past. Let me toss both of these out to you, Zach, for your views. I have argued that ETFs will not exist by the end of the decade. They will be replaced with tokenization. That ETF shares will simply become tokens of those shares because they trade 24/7, because they trade faster, because they trade cheaper, and with greater transparency and so on. Grover wants to know if any of that is applicable. Tell me your thoughts on all that.
I definitely agree to a degree. Like what I would say is that there's a better way. Tokenized markets are the future, and in the future you will see many of your assets and baskets of assets as like ETFs that work in a tokenized form rather than in their current form. That being said, when you look at the history of financial innovation, although things change and the growth comes from different places, legacy things seem to hang around for a very long time. I myself
Mutual funds are still here after all.
Mutual funds. I wrote a check with a physical stamp this last weekend for something. So, so these things are going to hang around. I don't think ETFs will die off in the same way as mutual funds have been around. But the marginal growth, the new innovation, where people are going to access a new products will probably be something tokenized. But the legacy systems probably hang around longer than we think. I think is often the case in financial services.
Inertia takes over
yeah.
more often than it really ought to, no question. So we talked earlier about the fact that Congress passed the Genius Act, the first ever crypto legislation, all focused on stablecoins. The Clarity Act is now up for grabs in Congress right now. Everybody was expecting it to be passed last year. We didn't get it. It's highly controversial today. Some in the crypto community have argued against it, saying it isn't good enough for what the crypto community needs and what consumers deserve. The banking industry has objected to elements of it because it all seems to be centering on the stablecoin question of yield. And several folks here are asking about all of this, so I want to get your views on this. Talk about this notion of yield. This seems to be a competitive threat between banks and crypto. Because banks pay yield on their deposits, stablecoins don't. But if stablecoins do, that would cause a lot of bank assets to leave and go to stablecoins where theoretically the yields would be higher because the fees are lower. And if that happens, will that hurt banks' ability to engage in lending, which they are the primary source of lending in this country? So if their lending capacity is harmed by their lower deposits, does that spell bad news for the overall economy? It's all kind of complicated in this logic flow. So talk about your views of all of this and the end game of will the Clarity Act be passed?
Yeah, there's a lot of elements. Let me try to get a couple things across here that I think are most important. The first is that the march towards regulatory clarity for blockchain technology and its integration in the financial system is much bigger than any one piece of legislation, any one elected official. This is something that's many years coming, that's international, and that's grounded in innovation. So don't bet against innovation. All of these things are coming down over time, and even if we can't predict exactly what happens over the short run. The second thing that I would say is that I don't want to comment on every particular kind of viewpoint on this legislation, but Grayscale would like to see this legislation become law. I think there's a lot of positive elements in it. particularly, the top line thing, Title I, Section 1 of this legislation, clarifies how to differentiate between digital commodities and securities, these types of things, and an asset manager operating in this space. That's really going to be helpful for us navigating the crypto as a class, servicing our clients effectively. So that type of clarity is quite helpful. I think it'd be positive for our business, positive for the industry and the asset class. We would like to see this piece of legislation become law. What about the yield issue? Look, what I want to say, I want to give an economist's take on this just to clarify something. If it is the case that commercial banks have to pay, they need to compete with stablecoins and had to pay a higher interest on their liabilities, could that have an effect on their willingness to make a loan? Yes. But don't confuse that with the health of the economy as a whole, right? The Federal Reserve sets the level of interest rates in the economy to manage overall growth, overall inflation. That's not something that the commercial banks decide. So the commercial banks are threatened by competition from a new technology. But we should in no way be confused by the idea that this means a slower U.S. economic outlook. It means competition within their industry. It does not mean weaker loan growth. That is something that's set from the top down by the central bank. And I think there's a lot of confused dialogue on this topic, Rick. So I just wanted to make sure to get that point across. So lots of moving parts. We would like to see this legislation become law. One way or another, we're going to get to a good outcome in the fullness of time, I have no doubt. And nobody likes competition. But the economy is going to be fine. And there's a lot of misunderstanding around this topic. But stablecoins are not a threat to economic growth. They're positive for economic growth in the United States and elsewhere.
It might be, bad news for banks due to the competition in that way. They'll figure it out. They'll adjust. And even if they don't, if there's a new kid in town who takes over domination, well, the consumer wins, the economy wins, even if the banks themselves lose. So, we didn't resist cars because it threatened the horse and buggy industry. And we're not going to resist tokenization and stable coins and blockchain simply because it offends Jamie Dimon. So, I mean, it's just, that's the nature of technological innovation. We move forward and it translates into short-term disruption, but in the long run, we figure it all out.
That's right. And there's disruption happening in lots of places of the economy. Obviously, AI is a disruptive force in parts of the economy. Public blockchains, Ethereum, Solana, the technology that we're talking about, stable coins, these are disruptive technology. That's exciting. That we need to be open to that. That's where productivity comes from in the economy. We're on the side of innovation here for sure.
We already are seeing tokenization in the financial markets. We've already had a couple of IPOs issue exclusively on blockchains. We've seen some that have issued simultaneously, traditionally, as well as on blockchains. And as you said, we're at the very beginning of this. It's not even the first inning. It's the first batter walking to the plate. What's the impact on the New York Stock Exchange on all this?
That's a great question. And back to the point about the market structure is still evolving. Exchanges will have a role in the sense of requires a matching engine between buyers and sellers. And so I don't know that exchanges, broadly speaking, should be thought of as going away. But there may be competition from new types of players. Some of the kind of crypto players want to be an everything exchange, trade crypto assets as well as equities, as well as prediction market contracts, et cetera. And you have US-based players involved in that business. You have offshore exchanges, really the leading exchanges in crypto are offshore. So I don't think exchanges per se will be disintermediated by tokenization, but they will require evolution. And I think there will be much more competition with new types of players, including offshore. New York Stock Exchange is an important kind of cornerstone of our financial system. I don't think it's going in any way, but it is evolving as it has for many, many decades to new types of market structure. I think the New York Stock Exchange will evolve and figure out a way to compete in a new tokenized future. That's how I think exchange is not going away, but everybody needs to update their process and their approach for a tokenized capital markets.
Here's an interesting question, noting that Bitcoin has a limited supply, 21 million coins in total, most of which have already been issued. Uh, Ethereum, on the other hand, has an infinite supply. So how do you correlate the two? How do you decide what a value is of ETH, given that the supply is not fixed the way Bitcoin's is? And I think the broader nature of this question is, which should I buy, Bitcoin or Ethereum?
Right. Let me answer that last question maybe most directly. Look, you think about what is the fundamental aspect that I'm trying to build into my portfolio. If it's adoption of stablecoins, then Ethereum. If it's store of value, digital alternative to gold, then maybe Bitcoin. Now, in reality, the lines aren't quite as crisp as I have just made them out to seem with that answer, but I think broadly speaking, that's how one can think about it. That if the goal is about the fintech aspects of crypto, if you will, stable coins, tokenization, decentralized finance, Ethereum is your first place to go. It's the home, there are other competitors, but it is the home for the largest amount of that activity today. If it's more of a macro thesis about debasement, then potentially Bitcoin. Now, both things bleed together a little bit on the margin, but in a simple sense, that's a good way to think about it.
So we've only got a couple of minutes left. I'd like you to share a little bit with us about the depth of support that Grayscale provides to advisors who are trying to get their grasp on all this.
Well, hopefully many of the advisors on the call are familiar with us already, Rick. We are out in the world all the time working with exactly the type of audience that you reach every day. The ETFs have really kind of broadened the scope of investor types that are able to incorporate crypto into their portfolios, and Grayscale is in front of advisors all the time. You can see some examples of how we do that up on this screen, but of course we have a sales force distributed all over the country with doing high touch engagement with advisors. I'm on the road, my team is on the road in advisor offices and at events all the time, and we're publishing lots of written material, research reports that go from the basics, how do stablecoins work, to more advanced topics, how does a decentralized exchange work, for example, and then doing all the complementary stuff, webinars, media, all that type of thing. So hopefully many people have seen us already. We don't hide well. We are in front of advisors every day.
And you have a wide variety of products. So talk about, if people wanted to figure out a way to invest in the stablecoin market, the tokenization market, as well as, of course, Bitcoin, Ethereum, et cetera, how can Grayscale help?
Yeah, so up on screen here is a framework that we call crypto sectors. People are becoming, of course, more familiar with Bitcoin. It's becoming basically a household name and in lots of different types of portfolios. But for people that want to take one step beyond Bitcoin and start to kind of understand all of the things that are happening in public blockchain technology or the crypto asset class, crypto sectors can be a great toolkit for that. This is like the GICS system for equities. We look at the stock market, we think there's different industries, consumer staples, industrials, et cetera. This crypto sectors is like that framework for the crypto asset class. We divide every element up in the crypto asset class into distinct use cases. And what Rick and I have been talking about today, a lot of it is that second kind of green square here, smart contract platforms. That's really the first place that you want to go. If your investment thesis is about stable coins, tokenization, you want to start digging into smart contract platforms. This framework's very good. We have an in-depth report on this topic. People want to go further, don't hesitate to reach out.
It's been terrific information as always, Zach. I'm really grateful for this content. I also want to remind you that I have written 2 white papers last year, the death of the 60/40 glide path and what you need to be looking at with the crypto modeling today, and the 6 mistaken beliefs that are preventing you from buying and recommending Bitcoin. Both of those white papers available at DACFP.com. The QR code is right there. And like I said, my brand new white paper on what's happening now in the crypto marketplace is being released tomorrow. You'll automatically get a copy of that. I also invite you to become certified in blockchain and digital assets. If you really want to become fluent in this topic so that you can proactively guide your clients, you want to get your CBDA. It's an online self-study course. Take it at your pace. You'll get up to 18 CE credits, and you'll not only learn about all this topic, but you'll also learn the practice management aspects of it, taxation, compliance, operations, the investment thesis, and how to explain all this to your clients. And I invite you to join us in Dallas in June, June 8 to 10, for our 8th annual Crypto Convergence. It's the longest running digital assets conference exclusively for financial advisors and accredited investors. And I invite you to join us there. The QR code is right there. And if you haven't yet read my #1 Amazon bestseller, The Truth About Crypto, it's available from your favorite bookseller, Amazon.com, and everywhere else. We also have a monthly e-newsletter that gives you the latest and greatest in the world of crypto. There's the QR code to help you get access to subscribe to that for free. And total change of subject, my newest book, The Truth About College. Zach's got his daughter headed to college soon. This is a perfect timing there. It's the #1 Amazon bestseller that will show you how your teen can graduate in 4 years, debt-free, on the dean's list, ready to enter the workforce in a career they want to work in. Zach, terrific info as always. Thanks again for joining us. I look forward to seeing you again soon.
It's been a pleasure, Rick. Thank you.
Thanks, everybody.